Hi, Todd VanDenburg here with VanDenburg Capital Management and another Uncommon Sense update. So we're a few weeks out from getting third quarter GDP numbers, and according to the estimates that I've seen from a variety of sources, the expectation is that in the third quarter, GDP is likely to increase somewhere between 20, 25 to 30, 35%. It's going to be an unbelievable rebound in the third quarter. But let's not get too excited about it, because the only reason that we have that kind of a rebound is because we had such an amazing collapse in the second quarter. So we will have been in a recession, because a recession is defined by 2 consecutive quarters of negative GDP. So first quarter and second quarter were negative. That recession will officially end, assuming that the GDP estimates are accurate here for the third quarter. So again, don't get too excited, or don't have any emotions at all about the numbers that we're about to see, because they're just a reflection of the fact that things got shut down so abruptly, and as things are starting to reopen again, well, GDP had nowhere to go but almost straight up. But that's not really what I wanted to talk about today. What I want to talk about today is the fact that I'm talking to a lot of people, and there's a lot of concern about the upcoming election, and depending on who you prefer to vote for, the perspective seems to be no matter which one wins, the other side thinks that it's going to be the end of the world. So if President Trump gets reelected, the people who don't like him think that that's going to be the worst thing in the world. And if you're, supporting Joe Biden, the people that are against him, they think that if he gets elected, it's going to be the worst thing in the world. And what I'm here to say is that, while who we have as our president is important, it's not the only thing that's important. So if you think about the stock market and what publicly traded companies want or need, it's that they need to know what the rules of the road are. And so depending on who's president or not president, that's not the most critical element. And what the most critical element is what legislation is going to get passed and signed by the president that would impact publicly traded companies. And so for the last couple of years, we've had a divided government. The Democrats have controlled the House, with the Republicans controlling the Senate and the White House. And in the upcoming election, if we have a divided government, again, no matter what that configuration looks like, what publicly traded companies will know is that the rules of the road aren't likely going to change much, because if there's one thing that we do know about Washington, it's pretty dysfunctional. And unless one party controls everything, there's not going to be a lot of big legislation that's going to have a major impact on publicly traded companies. So keep that in mind. And again, the reason that I bring it up is I'm hearing a lot of people, and they're having concerns, and they're wondering, what should I do? Should I sell everything, get out of the stock market, because it's going to be so volatile around the election? And the reality is there's no real right or wrong answer to that. It really depends on your individual risk tolerance and investment objectives. So anybody who wants to just sell and go straight to cash, more power to you. But just be aware of, okay, well, what is going to cause you to get back in? What math criteria will you be using to get back in? Because at some point, you're going to want to be investing, for your future. And so you're not going to sit in cash for the rest of your life. Now, there is one catch to that. So let's assume, in a retirement account, you can sell everything and there's no tax consequence, period. As long as the cash stays in the retirement account, you can sell everything and sit in cash for as long as you like. Money outside of a retirement account, you probably have some built-in capital gains there. So you really have to ask yourself, if I sell everything and go to cash, you're going to incur a capital gain, assuming that you have gains in your portfolio, which we hope you do. And so you're going to have to give that money to the government. So let's use an example. Let's say you have $100,000 of investments outside of your retirement account, and your cost basis, the amount of money you paid to acquire those assets, is $50,000. So you have $50,000 of gains. If you sell all $100,000, the government's going to charge you capital gains tax, state and federal, on that $50,000 of gains. So in California, state and federal, that's going to cost you, $12,500-ish. So if you sell everything in your non-retirement account and go to cash, you're taking a 12.5% loss, because $12,500 as a percentage of your $100,000 original value is a 12.5% loss. So keep that in mind. You have to think or believe that the markets are going to lose 12.5% or more and stay there for a long enough period of time to justify selling off all those assets. So kind of complicated stuff, but my broader point here is it's not wrong to be concerned about volatility, but you want to be making decisions about what you should be doing based upon something tangible, something math-based, and not just based upon emotion. Because if you do it based upon emotion, then you're going to have a different set of emotions that you have to deal with when the time comes to get back into investing. If anybody has any questions about this, their portfolios, the stock market, the economy, GDP, please feel free to reach out to me. I'm always here. I'd be happy to answer any questions that anybody has. But that was your update. I hope you enjoyed it. If you did, give us a like, give us a share, and I'll be back soon with another Uncommon Sense update. Thanks for watching. If you'd like to be the first to hear of more Uncommon Sense updates like these, please click the subscribe button below. We'd really appreciate it. Thanks again.